What does a run on the banks look like? We've all seen those chaotic scenes in movies where people desperately rush to withdraw their money from a bank. But have you ever wondered how and why it happens? In today's video, we'll be diving deep into the concept of bank runs, exploring their dangers, and understanding their impact on the average person. So, let's get started. Welcome back to our channel. We're Categories, and today we'll be unraveling the mystery behind bank runs. Our aim is to educate you about this financial phenomenon that has shaped history and continues to pose risks in the modern world. Imagine waking up one morning and discovering that the bank you trusted with your hard-earned money is surrounded by a frantic crowd. The fear of losing everything becomes palpable, and panic starts to set in. This is what a bank run looks like. Bank runs have been a recurring theme throughout history, leaving a trail of economic devastation and shattered lives. But what exactly is a bank run? Why are they so dangerous? And how can they affect ordinary individuals like you and me? In this video, we'll provide answers to these questions and shed light on the anatomy of a bank run. Our purpose here is to empower you with knowledge. By understanding the dynamics of bank runs, we hope to help you make informed decisions and navigate potential financial crises. Knowledge is the key to protecting yourself and your loved ones from the perils of economic instability. In the following minutes, we'll begin by defining what a bank run is and exploring its historical significance. Then, we'll delve into the anatomy of a bank run, uncovering the triggering factors and the snowball effect they create. We'll discuss the dangers of bank runs, including bank failures, economic ripple effects, and the erosion of public confidence. We'll also examine the impact bank runs have on the average person, both financially and psychologically. And of course, we'll explore the measures in place to prevent or mitigate bank runs. Finally, we'll wrap up with real-life examples and lessons learned, before concluding with some final thoughts and a call to action. Let's start by defining what a bank run actually means. A bank run occurs when a large number of customers simultaneously withdraw their deposits from a bank, typically due to concerns about the bank's solvency. Bank runs have been a recurring theme throughout history. One of the most notable examples occurred during the Great Depression in the 1930s when thousands of people rushed to withdraw their money from banks that had become insolvent. This led to a domino effect, spreading panic and causing more banks to fail. To understand why bank runs have such an impact, we need to explore the fractional reserve banking system. Banks don't keep all the money deposited by their customers in their vaults. Instead, they lend out a significant portion of those funds, assuming that not all depositors will simultaneously request their money back. This system works well until a crisis of confidence arises and a bank run is triggered. Bank runs can be triggered by various factors. Rumors about a bank's instability, news of economic instability, or a combination of factors can quickly sow the seeds of doubt among depositors. Once the first depositors start withdrawing their funds, it creates a snowball effect. Others, fearing the bank's collapse or wanting to avoid being left empty-handed, rush to withdraw their money too. This self-reinforcing panic can lead to a full-blown bank run. To help visualize the magnitude and impact of historical bank runs, let's take a look at some graphics and footage from past incidents. The immediate danger of a bank run is the potential failure of the bank itself. When a large number of depositors withdraw their funds, the bank may find itself without enough liquid assets to fulfill all the withdrawal requests. This can lead to the bank's insolvency and ultimate collapse. Beyond the individual bank, bank runs can have severe ripple effects on the broader economy. When banks fail, the flow of credit slows down, affecting businesses and individuals who rely on loans and financing. The collective impact can lead to a recession or, in extreme cases, a depression. Bank runs erode trust in the financial system. When depositors witness others frantically withdrawing their funds, it raises doubts about the safety of their own money. This loss of confidence can have long-lasting implications for the stability of the entire banking industry. Bank runs can have a direct impact on the average person's financial security. If a bank fails, depositors may lose their savings. This loss can be devastating for individuals and families who rely on those funds for their everyday needs or future plans. Even if a bank survives a run, it may impose restrictions on access to services. Withdrawal limits, frozen accounts, and limited availability of loans can create financial hardships for individuals and businesses, further exacerbating the economic impact. The psychological toll of a bank run should not be underestimated. The stress and anxiety caused by the uncertainty of financial stability can have a significant impact on individuals' mental well-being. To protect depositors, governments have implemented measures such as the Federal Deposit Insurance Corporation, FDIC, in the United States. These insurance programs ensure that even if a bank fails, depositors' funds up to a certain threshold are guaranteed. Central banks play a crucial role in mitigating bank runs by acting as lenders of last resort. They provide emergency funds to stabilize troubled banks and prevent their collapse. Staying informed about the state of the financial system is essential. By educating ourselves about the signs of instability and how the banking system works, we can make rational decisions during times of crisis, reducing the likelihood of panic-driven bank runs. Governments have implemented regulations and reforms aimed at preventing future bank runs. Historical examples include the Glass-Steagall Act in the United States, which separated commercial and investment banking activities. Modern measures have focused on stricter capital requirements and stress tests to ensure banks can withstand economic shocks. Let's examine some real-life examples to better understand the consequences of bank runs. One notable case is the Northern Rock Bank run in the UK in 2007, which marked the beginning of the global financial crisis. From these historical examples, we can learn valuable lessons about the fragility of the banking system and the importance of robust regulations, transparency, and proactive measures to maintain financial stability. In conclusion, we've explored the concept of bank runs, the dangers they pose, and the impact they have on the average person. From financial insecurity and restricted access to services to the psychological toll, bank runs can wreak havoc on individuals' lives and the economy as a whole. The best defense against financial instability is knowledge. Educate yourself about the financial systems, be aware of warning signs, and make informed decisions to protect your financial well-being. If you found this video informative and helpful, please give it a thumbs up, share it with others who may benefit, and subscribe to our channel for more insightful content on finance, economics, and beyond. Thank you for watching today's video. We appreciate your support and encourage you to leave any questions or comments down below. Let's continue the discussion. Before you go, make sure to check out these categories videos that provide more in-depth insights into financial stability, economic history, personal finance, and geopolitics.